Welcome to the deep dive. We've gone through the articles, the tax memos, and all the expert analysis to bring you the essential knowledge fast. Today, we were taking a deep dive into what might be the ultimate cross-border financial decision, retiring in Canada versus the United States.
And this is so much more than just, a geographic choice.
Right.
We're really looking at two fundamentally different philosophies on retirement security. And for anyone who's built assets on both sides of that 49th parallel, understanding the practical and sometimes, frankly, punitive tax consequences it's just non-negotiable.
That really sets the mission for us today. We're going to be extracting those key financial and tax nuggets you need to understand retirement readiness in both countries. So let's start with the macro headline, the shocking data point that really defines the two systems.
Exactly. When you look at the strength of that mandatory retirement safety net, Canada's system is, it's consistently cited as being far more successful at keeping seniors out of financial distress.
And the proof is right there in the numbers.
It is. The poverty data is stark. For Canadians over age 65, the poverty rate was 4.7% in 2021.
Just under 5%, and that is roughly half the poverty rate for seniors in the United States.
Ugh.
You immediately see the argument for the Canadian model just from that massive disparity.
It creates a foundational difference in how you even approach financial planning. And when we dig into the program details, you start to see exactly why that disparity exists.
Okay, so let's start with the most obvious difference then. The single biggest liability reducer for Canadian retirees, healthcare.
The contrast here couldn't be sharper. In Canada, you have publicly funded universal healthcare. It's a single-payer system available your whole life, including retirement.
And for essential medical services.
For essential services, copays and deductibles are, generally non-existent.
So that means when you're planning your retirement budget in Canada, the financial risk from a catastrophic illness is almost entirely mitigated by the state.
It's a profound shift in risk management. You're basically removing an entire category of financial uncertainty from your planning.
Okay, now compare that to the U.S.
Well, in the U.S. system, you're generally only eligible for Medicare when you hit age 65.
Right.
And even with Medicare, the coverage is partial. It typically excludes vision, dental, or hearing care. And you're still facing premiums, deductibles, and copays.
And our sources cite a really jaw-dropping figure for that liability.
They do. Some estimates show that a retired U.S. couple needs approximately $413,000.
Wow.
Just to comfortably afford Medicare premiums and their out-of-pocket medical expenses through retirement.
And that's not an investment. That's a cost. A liability you have to fund.
It's an anticipated cost that has to be funded from your personal savings. It completely changes the required savings calculation. I mean, do you put that money toward investment growth, or do you have to earmark it just to cover future medical bills?
It's basically the cost of entry for U.S. retirement.
Yeah, it is. Now, the flip side, of course, is that Canada has to fund that safety net somehow. And that means generally higher income tax rates than the U.S. It's a direct trade-off. Higher taxes now for radically lower personal financial risk later on.
Okay, so let's look at government retirement income. The U.S. relies mostly on one system, Social Security, but Canada uses more of a three-pronged approach.
That's right. Canada's system is layered. First, you have the Canada Pension Plan, or CPP.
Which is basically the Canadian Social Security.
Essentially, yes. It's funded by payroll taxes, and benefits can start as early as age 60.
And what about the other two parts?
The second part is Old Age Security, or OAS. And this is crucial. It's funded by general tax revenues, not just payroll taxes.
So it's considered more secure.
It's widely considered very secure, but it is income tested. If your income is above a certain threshold, your OAS benefits get reduced or clawed back. This targets the benefit to those who need it most.
Which makes sense. So the wealthier you are, the less you rely on the government's basic pension, which helps the system's stability.
Exactly. And the third layer is the Guaranteed Income Supplement, or GIS, which is specifically for low-income Canadians. This whole three-part approach is a major reason why that senior poverty rate is so low.
In contrast, U.S. Social Security is pretty much the primary pillar.
It's the main government pillar, yes. Eligibility is determined by earning 40 work credits. Benefits can start at 62, though they're reduced, or you wait for full benefits at 66 or 67. And while it does cover disability and survivor benefits, it is solely funded through payroll taxes.
And that dedicated funding stream is why you hear all these fears about it being underfunded in the future.
Right. It's a major point of political and financial debate.
Okay, so let's move on to how individuals save. Both countries use that tax-deferred model. Contribute pre-tax, grow tax-deferred, pay tax when you withdraw. We're talking the Canadian RRSP versus the U.S. IRA and 401k.
And the biggest difference here really is flexibility.
Let's start with the Canadian RRSP.
The Registered Retirement Savings Plan, the RRSP, is incredibly powerful precisely because of that flexibility. Contributions are tax-deductible, growth is tax-deferred. The 2024 limit is generous. 18% of your prior year's earned income, up to about 31,000 Canadian dollars.
But the core advantage, the insight that should grab anyone planning for their peak earning years, is that carry-forward rule.
That is the aha moment, absolutely. RRSPs let you carry forward unused contribution room indefinitely. Indefinitely. So imagine you had a low-income year in your 20s, or you took time off. That room doesn't just vanish. You can use it later, say in your 50s when you're in your highest tax bracket, to get a massive tax deduction.
That gives you immense strategic control over when you take your tax break.
It does. Now, there is a penalty for that flexibility. If you withdraw from an RRSP before you have to convert it at age 71, you face a substantial withholding tax up to 30%, and that contribution room is gone forever.
Gone forever, with a few very specific exceptions.
Right, like the home buyer's plan.
So let's switch to the U.S. counterparts. We have the traditional IRA.
The traditional IRA has a much lower cap, only $7,000 for 2024, plus a $1,000 catch-up if you're over 50. It has a 10% penalty for withdrawals before 59.5, though the U.S. system is a bit more flexible there than the RRSP. There are things like the 72T exemption for early retirement.
And the high-limit vehicle is the 401k.
Yes, the 401k is the employer-sponsored plan, like a group RRSP. Much higher limits, $23,000 for 2024, plus catch-ups.
But this brings us back to that core difference.
It does. 401k contribution room is strictly use it or lose it. You have to maximize it in the year it's available, or that opportunity is just gone.
So it's a trade-off. If you're a high earner, the U.S. has a higher annual maximum. But if your income is uneven, the Canadian RRSP offers way more strategic flexibility. It really depends on your career path.
Precisely. It's a trade-off between maximizing a few big numbers versus having that long-term strategic optionality.
Let's move to the tax-free growth accounts. And this is where things go from just being complicated to being outright dangerous for anyone with cross-border tax status. We're talking about a Canadian tax-free savings account, the TFSA, and the U.S. Roth IRA.
So both are funded with after-tax money. Both offer tax-free growth and tax-free qualified withdrawals. From a Canadian perspective, the TFSA is fantastic.
It's unbelievably flexible.
Right. Contributions aren't based on earned income, unused room carries forward, and the killer feature.
Yeah.
Any money you withdraw replenishes your contribution room the very next year. That's unparalleled liquidity.
But, and this is a huge, but if you are a U.S. citizen or green card holder living in Canada, our sources say the TFSA is effectively a landmine. Why?
It's the passive foreign investment company problem, the PFIC problem. The IRS does not recognize the TFSA as tax-exempt. Because it usually holds things like mutual funds, they treat it as a PFIC.
And that trigger, what exactly?
It triggers extremely complex, highly burdensome, and very expensive tax filing requirements.
We're not talking about just filling out one extra form here, are we?
Oh, no. The complexity is enormous. You have to file Form 8621, which often means you need a specialized cross-border tax preparer costing thousands of dollars a year, even for a small account.
Thousands.
And the penalties for not complying are severe. The tax treatment can be brutal, taxing gains as ordinary income at the highest rate, sometimes with interest penalties. For any U.S. person in Canada, the unanimous advice is almost always just avoid the TFSA.
Wow. So an account that is pure flexibility in one country becomes a pure tax liability nightmare in the other. Let's flip it. A Canadian resident has a U.S. Roth IRA. Is the Roth safe?
Unfortunately, no, not automatically. While the Roth is tax-free in the U.S., the Canada Revenue Agency, the CRA, doesn't automatically see it that way. They generally view the income growing inside the Roth as taxable every single year.
So what's the complicated paperwork solution for this one?
It's a high-stakes, one-time move. The Canadian resident has to file a one-time irrevocable election with the CRA under the Canada-U.S. tax treaty.
Irrevocable?
Irrevocable. It's Article 8, Paragraph 7. This election defers the taxation on that growth, making it act more like an RRSP.
So why is it irrevocable? And what happens if someone messes this up?
Well, the treaty rules are strict. If you forget to file it in your first year as a Canadian resident, you might lose the chance forever, and all that future income could be taxable annually. But here's the biggest trap. Once you file that election, you must stop contributing immediately.
Immediately.
Any contribution made while you're a Canadian resident is a Canadian contribution. That single misstep voids the treaty election, and boom, the income inside becomes taxable in Canada again, annually.
The logistics of just physically moving assets across the border sound like a true operational headache. What happens when you tell your U.S. brokerage firm, hey, I've moved to Canada?
You often experience what we call the liquidation shock. U.S. brokerage firms are not set up to manage Canadian residents, so when they find out, they frequently terminate your services.
But just like that?
They might liquidate your accounts or force transfers within a really tight window, sometimes as little as 30 to 90 days. This can trigger unexpected capital gains you didn't plan for.
That sounds terrifying for someone who spent decades building their portfolio.
It absolutely underscores the need for proactive planning. Now, there is a tax-neutral strategy for moving money from an IRA or 401k into an RRSP in Canada.
Okay.
Canadian tax law allows a lump sum transfer to create special contribution room equal to the gross withdrawal amount, so it effectively offsets the income with an RRSP deduction.
But this is where the U.S. gets its pound of flesh up front, right? This creates the infamous 30% cash flow trap.
This is the single biggest hurdle in the transfer. U.S. law requires a mandatory 30% non-resident withholding tax on that lump sum withdrawal. So if you withdraw $100,000 from your 401k, the IRS holds on to $30,000. You only get $70,000 in cash.
And the problem is, to get the full tax deduction on your Canadian return, you have to contribute the full $100,000.
Exactly. You must contribute the gross amount, the full 100K, to your RRSP. This means you, the individual, have to find that missing $30,000, the money the IRS is holding, from somewhere else. You have to borrow it or use other savings just to complete the transfer.
And you don't get that money back right away.
No, you don't get that 30% back until you file your subsequent tax returns.
And recovering that 30% is a complicated process using the foreign tax credit, or FTC. Can you walk us through the risk of actually losing that credit?
Absolutely. To get the $30,000 back, you first file a U.S. non-resident tax return. Then you claim a foreign tax credit on your Canadian return. But here's the critical risk. Non-business foreign tax credits cannot be carried forward.
They're use it or lose it.
Use it or lose it in the current year. So if your Canadian tax liability isn't large enough to absorb that full credit, you just lose the money.
Can you give us a quick example?
Sure. Say the IRS withheld $30,000, but because your big RSP deduction reduced your income in Canada, maybe you only owe the CRA $10,000 in tax that year. You can only use $10,000 of that $30,000 credit. The remaining $20,000, it just vanishes.
Gone. So the timing of the transfer is absolutely vital.
It requires high-level coordination. This level of complexity, from avoiding PFIC to filing the Roth election to managing the FTC calculation, it just screams the need for professional cross-border advice.
It seems essential.
It is. A cross-border advisor isn't just for compliance, it's for strategy. They help you figure out if you should even transfer the assets at all. Often, if you think you might ever move back to the U.S., leaving your retirement assets where they are with a dual license advisor is actually the most tax-efficient route.
Okay, so to summarize this deep dive, Canada offers a radically more robust government safety net. You've got universal health care, comprehensive pensions, and that leads to a much lower senior poverty rate.
Right. And on the personal savings side, the Canadian RRSP offers that unmatched strategic flexibility with the carry-forward room.
Meanwhile, the U.S. offers the globally recognized tax-free growth in a Roth IRA.
Provided you file that crucial treaty election.
And higher contribution limits in the 401k. The ultimate choice really hinges entirely on your long-term residency plans and your tolerance for complexity.
For sure.
So before we wrap up, we've mentioned the agony of that transfer process because of the 30% withholding tax trap. What's the powerful underlying reason that makes that whole process worth it if the move to Canada is truly permanent?
It comes down to one thing: estate tax planning. While moving U.S. retirement assets to an RRSP is complex and painful, leaving IRAs and 401ks in the U.S. exposes non-U.S. citizens or residents to significant U.S. estate tax.
And that exposure kicks in pretty low.
It kicks in on assets over just $60,000 US, reduced only slightly by treaty provisions. That multi-million-dollar exposure is eliminated entirely if those assets are successfully moved to an RRSP.
So that's the final calculation.
That's the critical calculation for anyone making a permanent move. Is the pain of managing that 30% withholding tax now worth avoiding the potentially massive U.S. estate tax exposure later? That is the trade-off you absolutely have to plan for.